Today is our first business day of our third century as a bank. We were founded not too far from here on 38 Wall Street in 1812,
Wow.
June 16th, 1812. And ever since then, we've been enabling progress for our clients around the world. One of the first things we did was we enabled trade finance for trade between New York and Liverpool. And ever since then, we've been connecting the world. We've been connecting the world for our clients. We financed the Panama Canal. We financed the transatlantic cable. And every day we go around the world to try and figure out how we can help our clients do their business easier.
And of course, things have gotten up
for our business in the emerging markets. They're still growing. I know they're growing a little bit slower than they were a few quarters ago, but they're still growing. They're not immune to the impact of Europe and what's happening. We feel it here, we feel it there. But if you look at the consumer on the ground, they continue to do well. Real estate continues to do well in a number of different parts of the world. But the biggest thing that's growing, Maria, is trade. It's trade between emerging markets and the developed markets. Trade in between the emerging markets. We're there. We're trying to help our clients navigate that, and it's growing for us.
Let's zero in on the news of the day. We had the Greek election.
Positive for keeping the euro together. We've long thought that it's important for Europe to have the euro together as one strong currency. They clearly have the wherewithal to do that. Having said that, we've got to be ready for every eventuality as a bank, and that's what we've been doing over the last. Let me tell you one more thing we've been doing. We've been looking at many of the countries and looking at them as separate countries rather than one country or one Europe, so to say. And so when you go to Greece, we tried to make sure that the loans we have are matched by local funding, local deposits. Why? You want to be asset liability managed on the ground, hedged on the ground. That limits your exposure significantly. They have slower volumes. They reflect the uncertainty in Europe. The uncertainty has been ongoing. I don't see that letting up in near time soon. But on the other hand, where we're seeing strength, we're seeing strength with the U.S. consumer. We're seeing strength in the housing market in certain parts of the U.S. And then we're seeing a lot of strength in global trade flows. And that's something which really drives economic growth. We've been quite positive about that part of the world.
So you are...
Think about the U.S. as one. And that's a positive. Different parts of the U.S. have decoupled from the rest of the parts. Yes, it's going to be a long time in Nevada. It's going to be a long time in Arizona. But certain other parts of the country have started firming up. You see that in New York City. You see that in certain parts of the U.S. So it's not one homogeneous market. And we actually are starting to see in these cities commercial real estate do a lot better. Rentals are very strong. So we're not done yet in terms of the recovery of the housing sector. It's going to take some time. Having said that, we like the signs we're seeing.
Extraordinary.
Things I think I'm sure the Fed's going to be looking at is not only the U.S. housing market, but what's going on around the world. But it's their decision, what they want to do. I do know that the Fed policies and the decisions they've made have actually helped not only bring interest rates down to where they are, but they've helped support housing. They've helped support the stock market and the market for financial assets. And certainly that's one of the things that's kept the U.S. economy stronger.
And of course,
continuing to sell down Citi Holdings. We started with Citi Holdings being 40% of Citi. Today it's down to about 10%. We sold 60 businesses in the last 3 years, almost $600 billion of assets. Having said that, we have one of the strongest capital positions in the world. We are at 12.5% on Basel I. We reported 7.2% on Basel III, Tier 1 Common, and we've said, and we're on track to be over 8% by the end of the year. We have almost $450 billion of